Greetings, folks. This is DC Investing, Reach Financial Independence, and I'm talking about topics that may help others on their path to financial independence. And, one of the things I wanted to chat about today is, you can take a look at different sectors in the industry and try to see which ones seem weak that may grow in the future, which ones are out of favor. And I've heard several podcasters recently talk about the overall energy industry, primarily the oil drillers. If you kind of look at the stock charts of something like XLE, which is kind of the oil driller index, it's really flat for the past year and a half or so. They do pay pretty good dividends. I think it's somewhere between 4 to 5% that this thing pays, just the overall index. And within it, there's several names that do much higher. Like one of the ones I'm interested in is Chevron, which is ticker CVX. I think it has almost a 5.5% yield right now. I had owned some ExxonMobil. I do own it, but it appreciated to the point where the dividend isn't as strong as Chevron. So, they've kind of been out of favor for the past while, and companies, it's sort of like they're just ignored by the overall market. They've been kind of weak. And I've seen some stories out there that I think there's something called the EIA that does an overall summary of the market. I think that's what it's called, but they're predicting doom and gloom and an oversupply, a huge glut of oil. And then various other folks are kind of talking about that, saying, we don't see what this, energy reporter sees. It's like the supplies in America are somewhat low. The Strategic Petroleum Reserve didn't get filled up, and Cushing is fairly low. And they're kind of saying that some people are trying to bump up, the amount of oil that they have out there, but some of them are actually even calling it a conspiracy to say someone is reporting that there's weakness in oil so that other folks can kind of get in and buy these companies that are a little bit cheaper. And it's really interesting because I definitely have seen layoffs happen in some of the oil producers. Like ConocoPhillips did a cut, Chevron did a cut. I think they also did a cut from Hess that they purchased, and there's several others that are kind of dialing back on the drilling rigs and the amount of folks that are in that industry. I think they kind of foresee some weakness in the economy coming up. But what happens is if all of those folks cut back on their production, in a year's time, you're going to have less oil that's being produced out there, and that could seriously raise prices. We may end up in an extreme supply crunch within a year's time or something, particularly if people expect a lot of weakness in the economy and that doesn't happen. There's a lot of growth that's happening elsewhere in the world. Like India is kind of trying to industrialize, and what happens when you get big populations that are all trying to move up the wealth ladder is they all get mopeds and drive themselves around, and then small cars, and eventually you get luxury type cars. But there's billions of people in India, and as they kind of go the same route that China had, where they try to industrialize their economy, it's going to affect energy prices because they're all going to be competing for those things. So I believe Africa is also undergoing a similar route where they're trying to industrialize the countries, and more people want access to energy. So every hydrocarbon that gets pulled out of the ground gets burnt up someplace. And the thought is, as long as there's not massive wars or extreme destruction within the economic wheels that we have in our world, more and more energy is going to be needed. So right now, energy producers are out of favor. They really have kind of flatlined over the last while, and you're kind of just getting a decent dividend yield, which I guess, as the Fed lowers interest rates, which I think they're expected to do this week yet again, and again at the end of December, all the people that are in money market funds and T-bills may get to the point where they start to look at, the comparison between what they're getting in money markets and T-bills to say, it's not even keeping up with the price of inflation. I've got to find some place that protects me from the devaluation of the dollar. And right now, a good place to hide out is things in companies that produce hard assets. And if you can get a 4.5% dividend yield from something like a ConocoPhillips or 5.5% from a Chevron. If you get in now, you're earning more than you would in a money market account. And then as people start looking for yield, they're going to look around towards investments that can pay them when they need the income. You can't get it in a money market account anymore. You certainly can't get it from a bank, but that's bound to be a tailwind in the future of just folks who are looking for income. So that's something to kind of consider about the energy market. So these are just some of my thoughts. I have been kind of buying or nibbling on a few more things. I think I bought some ConocoPhillips and some Chevron over the last couple of weeks. I brought some Petrobras. I think that was PBR. May not be a good time for that one or not, but I'm just kind of nibbling on some things. So just trying to put my Foreseeum hat on and try to say, what do I think, in a year's time might be the sector that is the place to be. So hard to say exactly what that is, but that's just kind of my 2 cents. Hopefully you got something out of this video. Like, subscribe. We'll see you. Thanks. Bye.